Mm-hmm.
All right, welcome everyone. We're very excited to be with you today from the Bonadio Group in Rochester. I have Mark Valerio, partner in the commercial practice with me here, and then we also have Jeff Haley, who's a partner in our healthcare tax exempt practice, streaming in live from his home. As you all are, I hope you are social distancing. We measured our feet, so we are correct here. And wearing your masks. I have to give a shout out to my mother who made me a homemade mask. So we hope you all are all safe and well. And while we cannot, as you know, help you from a health perspective, we are here to hopefully help you answer some of the questions regarding the PPP program, loan forgiveness. We're seeing your questions stream in. We do expect to try to answer them throughout. We might not get to all of them, but I've included in the slides. You could always reach out to one of our specialists for additional help, but we have been monitoring them and look to fill them in as we go through our discussion today. As you can see, for the housekeeping slide, make sure, I believe you're all on mute, and so the only way that you'll be able to submit a question is by using your chat box. And again, we encourage you to do so. That's the purpose of today's call, is to really have it be more interactive than we could in the past, and also to provide you some guidance through where we are today. And we always stress that today is April 21st, in case someone watches this on recording. This is where we are today, on Tuesday, April 21st. We do expect additional SBA guidance to be coming out in the next 2 weeks, specifically regarding PPP and debt forgiveness. We will be continuing to update you. I have a portion of today, we'll talk about the MainStreet loan program, and those are not official yet either. We expect those loans to start being facilitated in the beginning of May, and so we will continue to update you on this. But really, we felt the need to have this discussion today because we're fielding so many questions, and so many of our clients and community members are frustrated because they received their PPP loan. That's a good thing, believe it or not, but they're not quite sure the parameters for debt forgiveness. But then we also have a fair number of our community members who didn't get their PPP loan yet and are hopeful for a second tranche to come through, which we also will talk about today. So bear with us. You know, I'm a former teacher, so we have a real loose outline, and we're going to interject your questions that we see coming up throughout the presentation. The first thing we wanted to point out to everyone is essentially we sent out fine alerts, but I think it's been a week and a half now almost. I guess not. Maybe it was, I can't remember, to be honest with you. I think it's been a week and a half where the SBA came out with additional guidance and really broadened one more step for us to be able to get under the PPP loan program. And so all of us, I'm not going to get into too much of one. One had to do with if you're a small business concern, regardless of whether all of this happened under the CARES Act and PPP, here were the parameters you were allowed to apply for a small business loan. It had to do with employee-based or revenue-based size standards, and that existing law remained into effect. But what the SBA guidance really opened up for us with their clarification is they said, even if you don't meet the small business concern, which had to do, again, with revenue size-based testing or employee size-based testing, there is an alternative size standard test under the small business concern, and that was actually, I think it was pushed in 2006 when I went back and looked at it, and essentially they say ignore your employee headcount, and if your maximum tangible net worth of business income is not more than $15 million, and the average net income after federal income taxes of the business for 2 fiscal years before the date of the application is not more than $5 million, you could apply for a PPP loan. And this really opened it up to some people who maybe didn't fall under the first standard of small business concern or the extended definition provided by the CARES Act. And where we've fielded a lot of questions on this is, how do I come up, I'm going to try to do it at a very high level, but now we're hopeful, and Mark will talk about it in a little bit, that we're going to get another tranche of funding. So there is a fair number of people out there that are trying to get their applications ready. And so they say, how do I really get comfortable that I would fall under this alternative size standard? The one thing I'm going to point out, the net income after federal income taxes, we've had a lot of people say, well, I'm a partnership or I'm an S-corp and I don't pay federal income taxes. The guidance is that you would actually look at, you would apply the federal and state taxes that would apply if you were a C corporation. So if I was a partnership, I'd look at the C corporate tax rate at the time in which I'm evaluating the 2 full years. The other thing I think that's misleading about this is they talk about 2 full fiscal years. So a lot of us, when we first saw this, thought, okay, well, if I'm applying for an April, then do I have to essentially do a pro forma for if I'm a calendar year taxpayer to have a tax year end on March 31st? The answer is no. They confirmed to us that they're talking about your previous 2 taxable years, so that was good. In addition, we've gotten a lot of questions about what is average net income, and what I would say is a real gray area. Some people want to use taxable income, some people want to use U.S. GAAP, some people want to use another reasonable basis, and what I say is you would work with your FBA attorneys as well to consult with us to hear what we found on that. I'm going to pause here for a second because there has been a significant amount of discussion regarding the alternative size standard for not-for-profits, so I just want to allow Jeff to weigh in on that.
Yes, thank you, Lynn. On the nonprofit side, there's been a lot of interest in this alternative size standard, but the SBA's guidance has indicated that for not-for-profits, this is not available. You have to go with the employee number, which is the base number of 500 in the Act, or if you are in an industry that has an industry code where the minimum size standard in terms of number of employees is higher than 500, you can use that. But the alternate size standard here is not available to not-for-profits under the latest guidance from the SBA.
Right, and so hopefully we got some questions that came up, and hopefully that tells you for not-for-profits who might have been coming under the alternative size standard, at least the guidance at this point doesn't look like you can get in there. But I will say I had a question, is the $5 million in aggregate over 2 years? We conformed it to the average, so you can add the first year, the second year, and divide by 2. And so hopefully that answers that question as well. The third test we've been very clear on. It's what the CARES Act blew up, the availability to not-for-profits, 501c3 organizations, or veterans organizations, 501c19. I saw some panelists ask, or some people ask, well, what about C4, C5, or C6? Is that going to be included in the next tranche? I can only tell you I haven't seen anything. And Jeff is also shaking his head, no, we're not seeing anything. But obviously, I'm sure there's some lobbying going on there, and nothing's final until, the coal goes to fat lady sings. So when we see the final bill, we would obviously be looking for that information. This essentially opened it up, though, for a lot more people to get under the capability of getting into the PPP and the loans program. So the next thing we want to touch base on is obviously the PPP loan program is no longer has funding. And so it's very clear, I thought this graph that the SBA provided between Wednesday of last week at noon and Thursday last week at 10 a.m., they wiped out essentially the additional $50 billion they had left, and many people saw banks preempting this and saying, we have so many loan applications in the pipeline, we're closing out our loan process at this point in time because we're anticipating lack of funding. And it did go quickly, and we're going to provide you an update about that in 1 second. But we did want to point out, as well as Friday, April 17th, which was last Friday, they stopped accepting applications based on direction from the SBA. The SBA has also stopped, as many of you might be aware, accepting idle applications based on the lack of funding. We heard that the idle program was 4 times to capacity of their funding. I do think Mark's going to talk in a second that they're looking to push additional funding towards the EIDL program in the second tranche bill, or the second funding bill. I also would point out that we've heard mixed reactions from the banks as to whether some are accepting applications still for PPP funding for anticipation of there being more funding. Some banks will not, other banks are willing. And we also, I'm sure all of you have seen, there has been some indication, for example, Wells Fargo is being sued currently to say that they only provided PPP funding to their larger applicants as opposed to a first in, first out basis. So the banks are very much aware of what's the potential risk here, and I think we'll continue to tread lightly. The next piece, I'm going to allow, at this point in time, Mark to speak a little bit about what we're hearing is going on in D.C. Regarding, what is our expectation for the next bill? What will they have for us regarding EIDL and PPP?
Thanks, Lynn. Yeah, so anyone that's been following the news, watching the news over the weekend, listening to the news, or reading the news, it's hard to avoid the PPP discussion and debate that has ensued. I believe it was maybe a little less than 2 weeks ago that the additional funding proposal came out for about $250 billion more, and that was quickly voted down, and it's turned into a larger bill now, which is being deliberated likely as we speak. Yesterday, they reached, we're told, a tentative deal. There are no terms that are on paper. It's all word of mouth at this point in time, but it's anticipated that the Senate will vote on it again tonight at 4 p.m. in their session, and tomorrow it would go to the House as soon as tomorrow, hopefully. The terms that we're hearing in various media sources, and Senator Schumer has been making the rounds this afternoon as well, is that there's approximately $500 billion in this bill, including $310 billion for PPP. So in addition to the $250 that have been talked about for the last 2 weeks, there's $60 billion extra that has been earmarked for underbanked rural and urban communities. So $310 billion more for PPP, which is almost double what it was before at $349 billion. $60 billion is being the number that's being thrown around related to reinjecting into the EIDL program, which I believe that would be about 7 times the original funding. And if it was 4 times oversubscribed, hopefully that frees up some opportunities to those who have not received their money, those that were turned away, and potentially some others. And then, unrelated to the topic at hand today, 75 to 100 billion has been the number that's been talked about for hospital funding, particularly rural hospitals, and 25 billion for expanded testing funding. So again, these are all proposals. We will hopefully have a bill that we can see more concrete by the end of the day today, and hopefully the House is able to fast track that tomorrow. So we'll stay tuned for that.
We're very hopeful for it, obviously for many reasons. I had some people say, if I didn't originally apply for the PPP loan when it first came out, but now I've decided I would like to, does that prohibit me from doing so? No. So again, you go through the same test that we've always gone through. Are you eligible? And then you have to provide the proper documentation for the calculation of the loan amount, and you could still apply. The other thing people have been asking, and I think it's a very valid point that we've been talking a lot about internally, and I'll have Mark correct me if I'm wrong here, but based on our understanding, you might have been notified by your bank that you were approved for a PPP loan. But essentially, the bank approves you, and then it has to kick up to the SBA, and the SBA has to provide a stamped approval, essentially, to ensure that they had enough funds to approve it. So if you say, well, I received PPP loan approval, but I still haven't received the funding, you might ask the question, indeed, did the SBA approve it as well? If they did, and you were part of the initial allotment, they essentially have 10 days to get you the funding. If you got approved by the bank, but you didn't yet get approved by the SBA, I would anticipate that you would be one of the first ones to go up into the approval process, assuming that the second tranche of funding is approved by the government.
Yeah, and I'm seeing a lot of questions on this proposed bill. Again, we don't have the terms. We have not seen anything in writing, but there is no indication that the existing program would be changed to PPP. There is no indication that you can apply again. If you already applied and were accepted, we would anticipate that would not change. And other restrictions currently in place have not been lifted, including, the 75% payroll. I've seen a lot of questions on that. There's discussion, there's rumblings I've seen at least one senator talking about lifting that as it may be too restrictive on certain industries. But at this point in time, that has not changed. And just not to get too deep in the details here, but if you think about the semantics of how you determined your loan, it was based on payroll over a 10-week period, 2.5 months. So having that 75% threshold for requiring you to use 75% of the loan on payroll, it would seem realistic to accomplish if you were continuing to pay people, including, sole proprietor. So I've gone way deep in the weeds here, but the 310 is PPP. 310 billion is PPP. 60 billion of that is allocated to the rural and urban underbanked and underserved communities. The other 60 billion is idle. And again, these are the numbers that have been thrown around. Nothing is set in stone yet, but it's 310 PPP, 60 idle.
Yep. And I see, we are looking at your questions rolling in. We see a high number on debt forgiveness. That's where we're going to next. And we're seeing more on the payroll credit, which we'll hopefully get into as well. The one thing we want to say to people, I saw a fair number of people say they did receive the PPP loan. Your journey has just begun. Essentially, there's a couple things that you need to do, obviously. And so one of the things that we've been working with our clients that we do think is relevant and we want to bring up to your attention is that you have to certify a lot of things in order to take the PPP loan. And while we're not saying the banks the banks had some pressure to get that funding out, I think we all know, quickly, right? And so we are anticipating on the flip side there being a relatively high an audit perspective happening by the SBA to ensure that they were distributed correctly and that people were using them for the right way. So the first thing, you obviously certified on your loan application that due to economic uncertainty, you felt you needed the PPP loan, which is very broad, right? And so we're encouraging our clients to consider their internal documentation surrounding this. And so factors that would be deemed relevant when looking at this internal documentation is the understanding or documenting the current economic uncertainty, documenting how ongoing operations have been impacted to date by the economic uncertainty, understanding risk and reasonable expectation of future impacts that occur in the next few months, and how and why the loan is necessary to support ongoing operations. So that's really has to do with what you just did when you certified the loan. We're going to get into what you need to do for debt forgiveness, which is also going to be more documentation. But it is important, we feel, to have these conversations. Other things that are important is potentially even evaluating whether you should bring this up to the board for final approval, right? And making sure that this is a document that the entity as a whole has agreed upon. And then also being very pointed in your conversations regarding this. So those are all things that we've been guiding our clients through, and we just wanted to raise to your attention. So what next in this discussion is we're going to talk about maximizing the PPP loan forgiveness. We're going to explore the MainStreet lending initiatives, maximizing payroll tax credits, and talk a little bit about maximizing federal income tax savings. So let's dive right into the debt forgiveness question. I've seen some of them pop up. To be honest with you, they're quite rapid right now. But the first thing I want to point out to everyone is that, I can't stress enough, besides the CARES Act, that's all we have regarding the loan forgiveness. Meaning we are not comfortable, and even the banks are not comfortable providing any guidance surrounding this quite yet until we get guidance from the SBA, which we do know is unfair to people who have their PPP loans and now are in the process of trying to make sure they're dotting their I's and crossing their T's. But when you hear people who give you a definitive answer, I would be cautious. There are pieces that can be definitive based on the CARES Act, but all of us saw, and we'll talk about it in a second, that based on the CARES Act, there was no requirement that 75% of your debt forgiveness had to be used for payroll, but SBA guidance mandated it. So the point being, we really need the SBA guidance on this. We're going to raise some issues for you to track in your mind when you're thinking this through, when you are trying to obviously create perspectives of how to optimize. But I'd also point out that it's a moving target right now, and and for a little bit more, we have to be somewhat patient. So the first thing I want to point out to you is when you look within the CARES Act, the wording, like they tried their best, right, in a quick time period. We're not saying they didn't, but the wording leads to some wondering. And I've seen a lot of questions to the chat on this, and the wording says that you will be provided forgiveness of indebtedness on a covered loan, which is the PPP loan, in an amount equal to the costs incurred and payments made during the covered period. And if you literally read that interpretation, that would mean that the cost for your payroll, your covered mortgage, your covered rent, and your covered utilities must not only be paid during the 8 weeks after loan origination, but also must be incurred. So a lot of people are asking, well, what if I got my PPP loan and now I want to pay off, my mortgage that I didn't pay last month? Well, if you literally read that, or your mortgage interest or your rent that you didn't pay last month, if you literally read that, it says that, well, the only debt forgiveness you're going to get is the cost incurred and the payments made during the 8-week period after loan origination. And so that's one way it might come out based on guidance. The other alternative is that really what they meant, which I would assume, but there's a saying about assumptions, is essentially they're just saying that you can use your PPP loan for purposes of either costs incurred during the covered period, again, the 8 weeks after loan origination, or payments made during the 8 weeks after loan origination. And obviously that interpretation would be far more expansive. But the point we're trying to highlight here is there's no certainty right now. So we understand. We understand people are saying, well, I have payroll, and I might incur that payroll during the last week of my 8 weeks, but I normally don't pay it out until biweekly or monthly. That means that's going to come off, and we understand that. But what we're trying to get you, some people have said, well, I'm just going to move my payroll to weekly, and I would say, not yet. Okay, I'm not saying you might not explore that option, but we are anticipating guidance within the next 2 weeks, which would be week 2 or 3 within your 8-week loan origination that might allow you to divvy things up. So just be cautious surrounding this, I would say, and do your best to track. We've talked a lot about practices, and some banks have forced people to put their PPP loan in a different account so they could easily track it. It's not a requirement, guys, but I do feel like it might allow you easier access for purposes of explaining in case you do get audited on it. Plus, it doesn't commingle, if you do get audited, their ability to see everything else that's going on in your operations. And I would stop there to see if Mark or Jeff had anything to add to that.
Yeah, I would say on the topic of the regulations, the bill passed, the law passed on March 27th. The law indicates that the SBA has 30 days to write the regs. We've seen interim final rule 1, 2, and last week 3, which if you're a sole proprietor, I would encourage you to read interim final rule 3. That has all the specifics on how your application will be treated along with your forgiveness, to the extent we know what some of these things mean. But they have teased interim final rule on forgiveness to be forthcoming. Based on the 30-day window, we would anticipate we would have something within the next 5 days, unless they're going with business days, in which case it might be a little longer. There's also a SBA FAQ, which started with less than 10 questions and is now up to 30 questions. And they have begun putting timestamps on that on the top, along within the footnote section, to show you which questions were added and on which date. So they're not making changes to existing questions. If they do, there will be a footnote on that as well. It's imperative that you continue to reference those or talk to your professionals who are looking at those more frequently, because the rules are forthcoming on all of this. But for the various questions we've seen here on sole proprietors, I encourage you to look at that interim final rule number 3, which came out last week. I believe it talks about pledged loans and sole proprietors.
It's on the Department of Treasury website.
Yep. If you go to treasury.gov and you click the big red thing at the top, it'll take you to the PPP thing. There's 14 PDFs in there. It's near the bottom 4.
Or else, you can contact one of our team members. We'd be happy to share the link.
Exactly.
In addition, I just want to make sure, because I've seen it come up a couple times, you can apply for both the PPP and the EIDL loan. There is some strategy around it. Some people said, should I not take my EIDL loan and then take my PPP first? Think about it, work with someone, work with your advisors, but when I think about it, I think, well, to the extent I have my EIDL loan before my PPP loan, there's potential for me to roll in that EIDL loan into my PPP loan, meaning my PPP loan would not just be 2.5 times my payroll cost, but it'd be 2.5 times my payroll cost plus the EIDL loan. Granted, I received it, I think it was after January 31st, which this time frame would be, which means to me, the EIDL loan standing alone is holding up to a 3.75% interest rate. If I merge it into my PPP loan, now I'm down to 1%. So to me, it makes sense. But in no way would I deny a PPP loan and say, well, I'm waiting for my EIDL loan first. So there's a lot of things you have to consider. We need to move on. I know that everyone's going to jump in on this spreadsheet, and I think it is really important. You have to be careful when you're talking about covered period. They use the word covered period, both with what is the covered period for your PPP loan and what is the covered period for debt forgiveness. And so we're trying to highlight at the top, what's interesting is when they wrote the CARES Act, they told you could use your PPP loan for specific things. Those specific things are listed on the left-hand side. And they said you could use it during the time period between February 15th and June 30th. And I know if you were here, you would say, well, what happens if I use it after June 30th? It's a great question. We don't know. But essentially, we are trying to say, I think my goal would be trying to use my PPP loan for the variety of things between February 15th and June 30th. Now, in no way does that mean that I would necessarily spend it if I don't have to. I'm not saying that. But the items that they allow you to use your PPP loan for are listed on the left-hand column. Now, some of you might say, well, what's the penalty if we don't use it for that? Again, we don't know. It doesn't indicate in the CARES Act. We are expecting additional guidance from the SBA. But things you can use it on are payroll costs related to the continuation of group health care, which we all knew, payments of interest on any mortgage obligation, rent, and I will point out under rent, under both sides of the equation, debt forgiveness and under the PPP loan, there has been no exclusion right now for self-rent or rent to related parties. So that is important to know. Utilities and interest on any other debt obligations that were incurred before the covered period. And so as we're getting more and more into the details, some people are saying, well, then I compare it on the right-hand side to the use of loan proceeds for debt forgiveness. The covered period or the debt forgiveness time frame is not from February 15th to June 30th, guys. It's 8 weeks after your loan origination date. So if I took my loan out today, I go out 8 weeks, and that's the period I'm tracking for purposes of debt forgiveness.
And that's the day you receive the proceeds. The first disbursement of the loan in your bank account is the way the regs read.
Yeah. And so essentially now the next step is now tracking the expenses. It was not in the original bill, which we just talked about, but SBA said, you know what? To maximize the loan forgiveness, at least 75 must be incurred for payroll. So if you incur less than 75% in payroll, then that obviously would reduce the amount of debt you would be forgiven. We're going to talk about payroll costs in a second. It also includes payments on any covered rent obligation and covered utility payments. So some people might be looking at those gray spots that don't have an equivalent on the right-hand side, so please pay attention. The definition of payroll under debt forgiveness is linked back to the definition of payroll under the PPP loan proceeds. And the SBA guidance has, in my opinion, made it clear that payroll includes gross payroll expenses, right? And they also include, which would be maxed at $100,000 annually, and then it also includes employer-covered group health group health insurance costs. So because that's how the payroll is defined under the PPP loan proceeds, that also is how the payroll would be defined for debt forgiveness. So I think it is included in debt forgiveness. It is still quite clear though that the employer's portion of the payroll expenses are not included in debt forgiveness. The other thing I would point out is this interesting topic of, well, are only my interest on mortgage obligations included in debt forgiveness, or can I also include interest on other debt obligations? When you originally were comparing it, we originally thought probably just your payments of interest on mortgage obligation, but when you read the definition of covered mortgage obligation, it is quite broad. Meaning a covered mortgage obligation, I included it in the slide, is debt indebtedness or debt instrument incurred in the ordinary course of a business that is a liability to the borrower. It is a mortgage on real or personal property and was incurred before February 15th. So it does seem to me that that wouldn't just be related to mortgage obligations because they use the word indebtedness or debt instrument. However, we would appreciate more guidance on that. So the other thing I will get into in a second, a lot of people are talking about the payroll, so we're going to go to that next, unless you guys see questions we want to go through.
I just want to emphasize, this slide here is very important. We are going to distribute the slides within the next few days, but you take a picture with your phone, take a mental picture, look at this slide, and you have to remember there's expenses that qualify for use of funds, and then there's separate ones, a lot of overlap, but that qualify for forgiveness. I've received a lot of questions, and I continue to see a lot of questions in the chat about things that are on here that they thought should qualify. Debt payments, interest on debt that's not related to a mortgage, do not qualify for forgiveness.
Well, that's the debate. That's the debate. And I think because now we're seeing that a covered mortgage obligation, as they defined it, is indebtedness or debt instrument. And so the question is the interest on the indebtedness that's not the mortgage, is it available? I don't think it's clear, but I think based on the definition of the covered mortgage obligation, there's an opening that we need guidance on.
Well, yeah, I think you could have your primary mortgage, but to the extent anything's related to operating facilities seems to be what the spirit of the guidance to date has been. Even in the sole proprietor guidance, they talked about warehouses and other facilities. Mm-hmm. So rent related to those, or the mortgage interest related to those, which I think is where things will eventually shake out. Mm-hmm. But I've seen a lot of people talking about lease payments on vehicles or the interest on the debt related to those or anything else in the business that's essential to operate equipment-wise. But to date, it would seem that those qualify as acceptable uses of funds, but not toward forgiveness. So again, this chart shows you from February 15th through June 30th, because we continue to get the question as well, it's a 1% loan. This is great for us no matter what, even if we don't get forgiveness. Is there a consequence for not using it? We're not sure, but my comment has been to everyone, my caution, to me it doesn't make sense that there would be a separate subset of costs that are eligible use of funds that don't qualify for forgiveness if you were not required to use them all by the end of the covered period. Does that mean you defrauded the government? No, I don't think so. And that's the only language out there about fines is if you knowingly defrauded. But is there a consequence? Do you have to pay it back right away? We don't know. At this point, there's nothing that says you do. But keep in mind that there are these two categories, and they're highlighted here on this slide.
Go ahead, Jeff.
Can I add? I think that was a great discussion for the folks tuning in to hear, because there's so many interpretations and so many ways to look at these things. I would suggest that the key right now, before we get the additional guidance from the SBA, is to keep track of your expenses in detail and make sure that you understand what's in there, because when the guidance does come out and you have a clear, or we all have a clear idea of what's in and what's out, you'll be able to parse the data better if you're keeping track of the expenditures of the PPP funds, and actually of all your expenditures during this 8-week period. So keeping track of the expenditures during the 8-week period is, in the short term, is the key element. And when we get the guidance, which I do agree is going to come out in the next couple of weeks, you'll be able to parse that data and understand what goes into what bucket and what qualifies for forgiveness, and have the records more easily.
I think we're raising the point, document. Once you get your PPP funds, I totally agree. Track what you're using them for, document what you're using them for, and as guidance comes out, that can be dealt with. The one thing I'm seeing, I just have to raise it, a lot of people ask the question, I can go in for a loan, and we have it later on in the slide deck, but I could go in for a loan in May or June. What if I go in June, right? I'm technically under the covered period on the left-hand side, supposed to use all my funds by June 30th, but my debt forgiveness measurement period is from June 1st until 8 weeks out, right? Which would put us into July. And so my point being, absolutely, it is not very unclear. However, if the round goes as quickly as the round went last time, probably not going to have that problem, unfortunately. But that is something that's still out there. We're getting a ton of questions on payroll, so I am going to move into the payroll section of this to review with you. The SBA guidance, we were just really anxious for it, right? There was so much internal debate and external debate and people reading definitive words. And the SBA guidance finally came out, and let's talk about what are payroll costs. So remember, the payroll cost definition is the same for both the debt forgiveness piece of it as well as determining your loan. The difference is that for the debt forgiveness piece, we're only tracking the payroll costs for 8 weeks after we get the loan origination. For the determining our PPP loan amount, we're generally using the 2019 payroll costs to determine the maximum of maximum PPP loan we can receive. So the SBA guidance came out very clearly and said payroll costs are calculated on a gross basis without regard to federal taxes imposed or withheld, meaning you don't subtract for those in relation to the employee's share. So again, the gross payroll is the gross basis of what you're paying your employees. Payroll costs, though, do not include, which is what we referenced earlier, me as the employer's portion of the payroll tax. So, for example, in the most simplistic example, you might have payroll tax of approximately 15.3%. Half is paid by the employee, half is paid by the employer. The employee portion is included in that gross basis, gross payroll, and the employer portion is not. And then we had continuing questions, which you are, and we're not done yet, because we're not done with the payroll definition, but there was a lot of angst as to when does the $100,000 cap apply. Does it apply to the gross payroll of my employee, and then I look at the $100,000 annual cap, or do I also have to include other things I'm allowed to include in gross payroll, which you'll see listed here on the spreadsheet, which include the employer contributions to retirement funds, the payment for the provision of employee benefits, employer portion again, and then the payment of state and local taxes assessed on the employer portion. We're thinking here like state unemployment insurance. And so essentially they made it very clear that for payroll, start with the gross, back out anything annualized that's over $100,000, and then you can add in as well employer contributions to defined benefit plans, employer payments for group health care coverage, including insurance premiums, and payment of state and local taxes assessed. Again, those three items are added after the $100,000 maximum salary limitation. So the payroll definition is extremely important. I think we've nailed it down at this point, and I think we can use it both for helping people understand what's the max they can receive for the PPP loan versus what they should be tracking for purposes of debt forgiveness.
So Lynn, would you say, it's safe to start with 941 or W-2 wages, and then you add in the things that are outside of payroll?
For both, you have to be, for new businesses or for businesses that are seasonal, there's different computations for how much of a PPP loan you can get. But in general, yes, we can start with our 2019 payroll information to determine, 941s to determine how much of a PPP loan we can get, the max. But as you're stating, yes, we would also use a similar form to understand what are the payroll costs that we're tracking for purposes of debt forgiveness.
And the $100,000 maximum is also applicable during the forgiveness period?
Yes.
Because we've had that question on here as well.
Yes. So let's,
We have a couple questions related to payroll for sole proprietors,
yep.
pass-throughs, S-corps.
Great question. So let's talk about sole proprietorship. So the guidance came out Thursday last week, and then Friday there was no ability to provide PPP loans. So that was frustrating. But I think you've received beneficial guidance if you're out there as a sole proprietor. So essentially when you're looking at payroll, you obviously, if you have employees, can include your employees, but they've also said you can include, go back to your 2019 Schedule C, and you need one. And if you don't have it filed, you can use a pro forma. But you're essentially looking at the line that would say your net sole proprietor income. You're dividing by 12, and that's, or however many weeks, but divide by 12, and that's your monthly payroll cost. They're allowing you to multiply that monthly average payroll cost for essentially your sole proprietor compensation by 2.5, and that's the amount of loan you can receive. Go even further, which I thought was beneficial, is obviously Schedule C's income is fluctuating right now, right? I mean, it's not an easy market right now. And so they said, not only will we use the 2019 Schedule C to determine the amount of your PPP loan, but we'll also use the 2019 Schedule C information to determine the amount of debt forgiveness related to your PPP loan. So in the simplest example, let's say that my monthly payroll average based on my 2019 Schedule C would be $50,000. So now they would say, okay, 50,000 times 2.5 is the amount we're going to allow you, assuming you have no other employees, are the amounts we're going to allow you to get for your payroll PPP loan, and then the debt forgiveness would be that 50,000 times 2, or 100,000, automatic based on 2019 Schedule C. Moving on, S-corps. S-corps, you have reasonable comp. That's a good thing. So you can include that reasonable comp for purposes of your payroll. They did not say anything about you using your draws, or what I would refer to as your distributions, or your self-employment income, which would be what's flowing to you on your Schedule K-1. For partnerships, they did. In that guidance where they talked about sole proprietorships, they also provided guidance saying that payroll for partnerships would include the employees of the partnership, but you could also look at guaranteed payments and self-employment income of the partners. Again, capped at $100,000 annually. And while many people got excited of that, and I'm not saying you shouldn't be excited of that, I'm going to kind of deflate your bubble a little bit. And the fact that, however, for debt forgiveness, they were silent with relation to partners' guaranteed payments or partner self-employment income. Meaning that while it can increase the amount you're allowed to get for your maximum loan amount for PPP, your debt forgiveness is silent. And right now, based on what they're saying and based on the guidance, you would not get debt forgiveness for that partner's guaranteed payments or self-employment income. Do I think it was oversight? Potentially, but at this point in time, you can't. So hopefully that was useful. The next thing we're going to talk about, a lot of people are asking about FTEE, and let me shout it from the rooftops. We do not know the definition of an FTEE. I know people are pressing and saying, well, I heard from another firm. We have tossed it around. In the actual loan forgiveness section of the CARES Act, they refer to a full-time employee equivalent, but they do not define it. They do define it later in the CARES Act when talking about payroll credits. And so is it an okay assumption to assume that an FTEE is 30 hours of a general 40-hour work week would give rise to 1.0 FTEE? Sure, I think that's a reasonable assumption. Is that a fact? No, not at this point in time. So I think it's a reasonable assumption for purposes of what you're trying to do at this point. So let me be clear, because I think a lot of people are goofed up on this as well, is we first are going to measure our costs from the 8 weeks after the loan origination fee. Let's say when we measure all those costs, we find out we took out a $2 million loan, and we're going to be allowed debt forgiveness of $1.8 million. This is then that $1.8 million might be reduced depending on two factors: your full-time employee equivalent count, or a decrease in payroll that's greater than 25% for people who made less than $100,000. those two factors could decrease. In my example, I think we said we were going to get debt forgiveness of 1.8. Those two factors could decrease the amount of 1.8. So the first is, well, what do they mean by FTEE equivalent? We already touched base on the definition, but essentially you're going to measure your FTEE equivalent during the 8 weeks, and you're going to compare that to the lesser of your FTEE equivalent between February 5th of 19 and June 30th of 19, or January 1st of 2020, ending on February 29th of 2020. So let's assume in the most simplistic example, during the origination period, 8 weeks after, I have 80 FTEEs. The lesser of those two time periods that I look at is 100. So 80 over 100. Without looking at anything else, now my 1.8 million of debt forgiveness that I wanted is going to drop 20%. Because I'm 20% below in that formula, 80 over 100. You're supposed to technically 1 minus 80 over 100, right? So now it would drop. The significance of this that we're trying to talk people through, though, is they do say to you, if you ramp back up by June 30th and you have the same FTEE equivalent on June 30th as you do on February 15th, we'll ignore that 20% reduction in my example, which is a beautiful thing. Some people have come out and said, well, what if my FTE count was 80 on February 15th and my FTE count on June 30th is 78? Isn't it close enough? Close enough has not been defined at this point. They do provide a de minimis exception in the law, but they don't define de minimis, and I think that's where we need the SBA guidance. Meaning, should I still get suffered the full 20% if I'm back up by June 30th or not? And so we can't give you any guidance at this point other than we're waiting for guidance on that particular fact pattern.
So Lynn, to be clear, if you spend only 80% on qualifying costs, all things considered, you would only get initially maximum 80% loan forgiveness. But if you do not bring your workforce back to 100% and it stays at that 80% level at June 30th, you will get another 20% haircut on the already reduced 80%.
Correct.
So that is why it's critical to remember, even if you're at June 29th and you don't see a way to keep everyone busy for the next day, the next week, whatever it may be, you do have that additional incentive to put your workforce fully back in place by June 30th and save that additional haircut.
I think we've been fielding that question a lot, and I'm going to throw it out to Jeff, too, to weigh in, but I think we have a facts and circumstances test at this point. We've been asked a lot, my employees aren't going to do anything. Do I just hire them back to maximize debt forgiveness? It's a facts and circumstances test, but if your employees really aren't doing anything, I'm not quite sure if you'd want to use that funding towards that. However, I think maybe when you started analyzing the time period in which you need to use your funding, which is February 15th to June 30th, and if they're going to lock hard on that June 30th date, then eventually you're going to have to bring them back. So now is the time, maybe in the next 8 weeks you say, I'm not going to ramp up, but I'll definitely ramp up by June 30th. There's some analysis going on in there to say, well, I'm not just going to hire them back now and then pay out of my own pocket to get them to June 30th, but maybe I'll only bring on, the essentials right now, and then I'll take the load at 1% to get us to June 30th. There's tons of facts and circumstances which our consulting teams are dealing with people on this, but I'll let Jeff speak to it as well.
Yeah, Lynn, so you're making a good point, and we're getting a lot of questions in the chat about how do I maximize the forgiveness if a bunch of my employees are furloughed, and the answer is you don't. If they're not on your payroll, you're not going to maximize forgiveness. And we even have questions: should I just hire a whole bunch of people, even if they're not doing anything, just to maximize the forgiveness? And I think you have to think about strategically. A lot of people are going to be actually having a higher take-home pay on unemployment. And you have to think about this not just in the context of the loan forgiveness of the PPP program, but also of your relationship with your workforce, your employees, things like morale, employment law, a lot of other types of things. Don't just focus on maximizing the forgiveness, because strategically it might not be the best thing for your business and your overall operation going forward. So it's something that we've been strategizing with a lot of our clients, but it's a complicated question that is not as simple as, yes, go for the maximum forgiveness. That might not be the best answer in the long term for your company.
One thing I've seen though, Jeff, is I've seen a lot of employers, some even before there was the option for forgiveness, that continued benefits to furloughed employees through April, and now planning to extend those into May. And, that would be a cost that would be eligible for forgiveness. So even though you are not paying the employees, if you're paying the healthcare costs and any other benefits that are eligible, you could get the forgiveness related to that.
But we're also going to see a negative impact of that as well, which we'll talk about in a second. We did just get some questions on the FTE count. I just want to point out, somebody said, well, if someone willfully left, can I include them in the FTE count? No, it's based on a 30 hours per week schedule. So it's, did you schedule them for 30 hours per week during the loan origination period? We also got some questions about 1099 miscellaneous employees. Those are not included during payroll, even though initially, this is something else that came out, even though initially the CARES Act intended it to be, they noticed the potential for double dipping. The employer asking for a PPP loan on behalf of their 1099 miscellaneous independent contractors, and then the independent contractor could also ask for the loan. So some people said, well, should I change my 1099 miscellaneous employees to 1099 miscellaneous independent contractors to employees to maximize the debt forgiveness? And my piece there would be, if you really want them as your employees from a variety of perspectives, yes, but I would be hesitant if it was only for purposes of maximizing the debt forgiveness to change someone from an independent contractor to a full-time employee without further investigation.
Then we have a lot of questions on, can we increase employees? Can we hire new employees? Does it have to be the same employees? Can we increase pay? Can we pay bonuses? 401k contributions, matching contributions, profit sharing, union benefits. And then how the 100K test plays into all of it.
Okay, so let's first, I can't remember all of them, but let's first talk about, can we increase employees? Absolutely. Do they have to be the same employee? Not based on the language we're reading. What was some of the other ones? Bonus for pay, I would say, yeah, you can pay them a bonus during that time period. Again, though, you're capped at $100,000 annually, so watch out. And B, remember that you only get to forgive 100% of the PP loan in which you are utilizing, right? So even if you have enough covered rent, right, and covered mortgage, and to get to that 25%, and your payroll 75%, even if you pay your employees a bonus, that's not going to add to debt forgiveness, right? So I hope I'm trying not to minimize the question, but it's a calculation,
right.
So be careful.
Yeah, you got to look at your 75%, but if you're well short of it and you have padding and room, and you want to pay a bonus to your employees, or you want to give them a raise for hazard pay, which I've seen a lot of people going $2, $3, $4, $5 an hour increase,
yeah.
That would certainly qualify.
Well, what we think it would qualify. We haven't had guidance yet, but we
based on what we've seen today.
Yeah.
And one other caution I'll tell people is I have talked to people that they wanted to make that payment or pay a bonus as an advance on the typical year-end bonus, and I caution there that this again goes to that incurred and paid. If you normally give a bonus at the end of the year, but you're trying to advance it now, that would potentially, be changing things and not be incurred.
Yeah, I think we definitely need. So that's why. So to the point of hazard pay, if you increase the wage amount per hour, I think that's almost that's more definitive if we're trying to keep to that paid and incurred stance that currently exists. If we provide a bonus, I think you would have to work closely to make sure you're identifying what that bonus period is related to. And so there's a lot of things surrounding that, I guess I would say.
On the 75% test, Lynn, because we've had a lot of questions on this, people were under the interpretation that they could go up to 100% of payroll costs.
Absolutely.
So you can go over that 75.
You just have to have at least 75. So for example, if I have a $100,000 loan, and I only use $60,000 for purposes of payroll, I'm going to take $60,000 divided by 0.75, and that's going to be the max amount that I can get forgiven, assuming that the remainder, the appropriate amount, was used on something other than payroll. If you are above 75,000, then you can, you could go all the way up to 100%. It's just they want at least 75% of the debt forgiveness to be used on payroll.
Got a couple questions on workforce reduction. We talked about how the law says any workforce reduction or furlough from February 15th to 30 days after the enactment of the law, April 26th. If you restored that by June 30th, it would be forgotten. People asked about, what about people that are still furloughed after April 26th? As long as that reduction occurred before the 26th. The exception is in there, correct?
The exception is that I can ignore all the decreases in my FTE count based on testing periods. If by June 30th, that's your testing date, the FTEE equivalent is the same as the FTEE equivalent was on February 15th. But it brings me to my next point that I really do want to get to, because the piece of this, though, is there's not just, it's because it has to do with furloughed employees. The piece of this is not just related to FTEEs, which I think you could easily say a furloughed employee doesn't fall under that definition, right? Someone who was scheduled for at least 30 hours during a 40-hour work week, because your furloughed employees aren't scheduled to work. But I do think there needs to be more clarity regarding the requirement to reduce your debt forgiveness for a reduction in salary. So remember, there's two buckets that could reduce your ultimate debt forgiveness. One has to do with FTE equivalent, and one has to do with salary reduction. And they say your loan forgiveness will be reduced by the amount of any decrease in total salaries and wages during the covered period, meaning the 8 weeks after loan origination date, that is in excess of 25% of the total salary or wages of the employee during the most recent full quarter. So, for example, if I'm in April, my most recent full quarter is January, February, March. Even if I get it in May, my most recent full quarter is January, February, March. And what's interesting is the way the law is written right now, we would be comparing what our employee, Jane Doe, made in 12 weeks compared to what she made in 8 weeks. I don't think that was at all their intention. I think they probably want it looked at by a week-by-week or a day-by-day basis. But the way the law is written, there would automatically be a reduction. I'm not too worried about that. What I am worried about, though, is this furloughed concept. So you might say, oh, I clearly haven't decreased my salary of any of my employees less than 25%. For the employees you haven't furloughed, but are your furloughed employees captured in this calc? Because technically, they're still your employees. And so I think this definitely needs clarification. I would point out the last time, though, that, again, if you come back up by June 30th, both from an FTE equivalent and from a furloughed equivalent, meaning you bring them off furlough and they're back on the payroll at the regular pay, it seems as though that could also be ignored. So June 30th, 2020 is a real important date. And the one thing I want to point out about that date, or this passage, is some people say, well, what does it mean that I have eliminated the reduction in salary? Do I need to give them back pay? That wouldn't be my presumption, right? But again, it's still unclear. So we need additional guidance. I think what it means is you bring them back by June 30th and you're paying them the same salary as you were paying them before.
And for several questions we've seen on going beyond June 30th, if you receive your loan, if the program is refunded and expanded, if you receive your loan with less than 8 weeks till June 30th, yes, you can go. Your 8-week period would go.
We don't know.
Well,
we don't know.
Based on the way it's written, the program is open until June 30th, but your 8-week measurement period doesn't start until you receive funding.
Right, but the PPP loan actual piece of it says you have to use your funding by June 30th. So what happens if I'm using funding from June 30th?
Yeah, the covered period is certainly through June 30th. So you would have had to spend at least that much on qualifying costs in the covered period.
Right.
But for forgiveness, it's the 8-week period. So it seems like something has to be sorted out there.
Yeah.
But yes, you could, if there's funding, you could continue to get a loan through the end of June. And your 8-week period still starts on that date, and we hope would go beyond that date.
And we hope would go beyond June 30th, absolutely. Jeff, do you want to weigh in here on anything that you've seen regarding these 2 points?
No, I think you two covered it. I think there's a question from earlier that I think is worth addressing, and there were a bunch of questions earlier when we were starting off that talked about I applied for a PPP loan, but I haven't heard anything. And I want to be clear with everybody that the only path there is to call your lender and find out what the status is. So if you applied for a PPP loan and you haven't heard, call the lender. That question we can
And
actually
Jeff, to expand on that, I believe it's question 20 in the FAQ. It indicates that lenders have 10 days from SBA approval to disperse the funds. So SBA approval at this point is really a allocation of a loan number, an SBA loan number. So you can talk with your lender, and that might be the question: do I have the SBA approval? At this point, you may have internal approval from the bank, but they may not have received SBA approval. And as you saw from the slide earlier with the graph showing the timestamps during the day last Thursday when funds ran out, it was rather quickly, and that timestamp was as the SBA was pushing out the loan numbers, and that's what's in there. So your lender does have 10 days to disperse those funds.
We got a great question, which I really would like to touch base on. It says, how long after the 8-week period will it take to learn what I've been approved for debt forgiveness? So here's some things that I would say to you. There's a play here with our payroll tax deferral. And I don't want to say play, but essentially, if your 8-week period runs out before June 30th, I still think you're going to want to wait till June 30th to see if your FTE count is high in your back to fully salaried, right? If you say, well, that wasn't an issue for me, then you might have a different scenario. So again, very facts and circumstances. But let's assume you needed that June 30th date to ignore those two provisions of reducing your debt forgiveness. They don't tell you anywhere, I actually looked it up for some clients yesterday, they don't tell you anywhere in the Act how long you have to apply for the debt forgiveness. They do tell you in the Act that the bank has 60 days from the time in which you apply for your debt forgiveness to give you an answer. And so some people are saying, well, I at least have to wait to June 30th. By the time I get all my documentation in a row, it might be the end of July. And so I might not know until September 30th when or if I receive debt forgiveness. I think it is important to point out that the debt forgiveness is not just related to the principal, but any interest that has been accrued related to that principal during that time, which is beneficial. But the piece that I think has been unclear until last week when the IRS issued a Q&A fact is that many of you might know that you're allowed to defer your OASDI, which is approximately 6.2% the employers pay for each of their employees. You're allowed to defer that until the time in which the bank tells you what your debt forgiveness amount is. And for all my self-employed individuals out there on the call, that includes you. You're not allowed to defer all of your self-employment, but your 6.2%, what you normally, your employer would have paid if you were in an employee and employer relationship. So essentially, if you're thinking, if you didn't put that into your cap, put it in now because you have a 0% loan. So whatever I pay my employees on OASDI for 6.2%, starting on March 27th, it is the only payroll movement that started before April 1st. So on March 27th, till the time in which the bank notifies me that I received debt forgiveness, so in my long scenario, September 30th, I can defer any OASDI I paid on behalf of my employees and not have to pay it. No interest is attached to this. 50% on December 31st, hear the words, 2021, and 50%, the remaining 50% on December 31st, 2022. That gives you a 0% loan for that amount, 50% not having to be paid until 2021 at the end of the year, and the remaining 50% until 2022. And so while people, I just point that out because I think that was unclear initially, and I think it's become much clearer.
Lynn, people have asked the mechanism to do that. Is it just underpay and report on your 941, and will the 941s be updated to reflect that?
So the OASDI portion is to underpay, and what we found is if you call your Paychecks or ADP and you tell them, I do not want to be submitting my OASDI, they'll just stop doing it. Now, when they do that, it is not their liability on December 31st, 2021 or 2022. It falls back to the employer, but yes, you can do that. However, I did see some people say, it is important to note the remaining payroll tax credits related to the Families First Corona Response Act for extended leave and extended sick leave, the employee retention credit, as those all don't kick in until April 1st. So we won't be needing to put them in that form until the second quarter, which the IRS has adjusted the form for the second quarter.
Okay.
Okay. I think I want to definitely get to the MainStreet loan program, pass it over to Mark. I just want to point out, we're going to go through quickly. This is really important, guys. I think a lot of people missed this initially, which was essentially that, including, our first webinar that we had on this week, we didn't bring it up, but I want to make sure we're bringing it up now. The CARES Act very specifically says that any debt forgiveness is not taxable income. True. So in my previous example, if I get forgiven $1.8 million, then that's not included as taxable income. However, we have not received clarification, and under the current U.S. federal code system, there's a section called 265. And section 265 says if you had expenses related to tax-exempt income, they're not deductible. So while the $1.8 million wouldn't have to be an income item on my tax return, under current law that exists today, whatever I use that $1.8 million on, such as wages and such as mortgage interest on covered mortgages, covered rent, covered utilities, they wouldn't be allowed as a deduction while calculating taxable income. Now, what I would tell you is there have been exceptions to that rule in the past, but people need to be aware that as of now, yes, the debt forgiveness isn't allowed, but any expenses you paid with that debt forgiveness will also not be allowed, which you might say, it's a wash, right? Which I might say, yeah, but for my flow-through entities, consider 199A wage limitations. For my state apportionment friends, consider how that, because 75% of that debt forgiveness is going to be related to wages, how that might affect your state apportionment throughout the United States and your state income tax nexus. There are ramifications for that. And then lastly, we also included in these loans, please remember forgiveness is not guaranteed. You have a lot of documentation, which was my joke earlier. Your journey has just begun if you got a PPP loan. Not only do you need to internally document that there was economic uncertainty, but you also need to be on top of documenting what you're using the funds for.
Is it anticipated that all forgiveness would also not be taxable for state purposes?
Oh, no idea. No, I don't anticipate that. The states are bleeding right now. If any of you remember the backlog with the Wayfair case, they were jumping all over sales tax. They were very excited. They were bringing in revenue. That revenue has dried up because they're not getting their sales tax because people aren't buying. They already are being affected by these federal changes that were made to the interest expense limitation, the net operating losses. New York has weighed in and said they will not take the interest expense modification rules that the federal government has done. We are still waiting for them to weigh in on other acts, but I would not make that assumption at this point, guys, because I think states are hurting significantly. Okay, at this point, I'm going to turn it over to Mark, who's going to talk to us about the MainStreet lending facilities.
All right, so the MainStreet lending facilities, Section 4003 of the CARES Act outlined certain benefits for mid-sized businesses. And one of the provisions in there, this is the section that covered the airline industry, air cargo carriers, and those related to that. But they also had a section for the mid-sized companies. And within that, there was a subsection that gave the Federal Reserve Board the authority to create a MainStreet lending program. So on Friday, April 9th, I believe it was, or Thursday, April 9th, the Fed had a press release and announced a big $2.3 trillion package. Included within that was the $600 billion MainStreet lending facilities. Within that, as appropriated by Section 4027 of the CARES Act, was a $75 billion, I'll call it a backstop from the Treasury for this program. Now that's all semantics. Here's how it really is going to work. The eligible borrowers are businesses up to 10,000 employees or up to $2.5 billion in annual 2019 revenue. And each eligible business has to be organized in the U.S. Under U.S. laws or have significant operations in the U.S. with employees in the U.S. as well. All right, so you can see here a comparison of PPP, and then there's two facilities that they set up under this, the MainStreet New Loan Facility and the MainStreet Expanded Loan Facility. And you'll see those abbreviated as the MSNF-LF and the MSELF, I'll call it. And with PPP launching in April, it's anticipated they will launch in May, early May, it's said. The Federal Reserve Board, in their press release, they included links to two term sheets, one for the new loan facility and one for the expanded loan facility. So everything we've included here is based on those initial term sheets, which have that timestamp of April 9th right on them. And they're all subject to change. They had a comment period that was open through April 16th, and we would anticipate final regs on these, as well as any changes to the term sheets at that date. Now, keep in mind, these will be facilities that also, just like PPP, will be offered by your lender, and the mechanics of it is the Federal Reserve will buy a 95% participation interest in that loan. 5% will be held by your lender. Will every lender participate in this program? It's unlikely. I don't think it'll be like PPP where it'll be so expansive. At this point, we don't know. There certainly is some incentive in there for lenders. I believe 25 basis points from the Fed to 125 basis points for closing costs. So these are more like a traditional loan, but there are certainly, I'd say, a lot more restrictions than a traditional loan. They are with recourse, but at this point, we don't believe there's any collateral requirement. The interest rate in the term sheets is pegged at a variable rate right now, based on the SOFR rate, which last night was at 3 basis points. That's 0.3%, plus a spread of 2.5 to 4%. So you'd be looking at an interest rate anywhere from 2.53 to 4.03%, potentially, depending on what the final terms are. And the period for these loans is 4 years with a 1-year deferral period, which is actually on the next slide you'll see. And the minimum loan amount is $1 million for both of these facilities, and the maximum loan amount is $25 million, or subject to some limitations based on current available untapped credit facilities that you have. And then for the expanded one, $150 million, or 30% of your available existing debt, or capped out again based on your current leverage. So I said there's a 1-year deferral of principal and interest on these loans. And the only other big item on these, remember, there's no forgiveness. Next slide, please. There's no forgiveness on these, but there are parameters. There's generally not as restrictive provisions on how you can use the funds as there are with PPP, as there is no forgiveness. But there are certain required attestations, both by the lender and the borrower. And some of these include that you will not repay or refinance pre-existing loans or lines of credit. Now, the financing is required due to exigent circumstances presented by coronavirus. You do meet the EBITDA leverage conditions that I previously talked about that are more detailed in the regs, in the term sheets themselves, and that you must follow compensation, stock repurchase, and capital distribution restrictions. Those were widely publicized related to the airline industry, and they're also subject to borrowers under these facilities. So keep in mind, these are more, I'd say, focused on companies that truly need them, and it's not just an alternative to your typical bank financing, or if you have existing credit facilities available. Those would be the first place you'd want to turn. These would be more, a distressed type arrangement. I don't want to say distressed entirely, but that's really what they're emphasizing here. And Jeff, would you have anything you'd like to expand on that?
Yes, thank you. I think it's important to note here that in these term sheets that were issued on April 9th for this program, it was not mentioned whether nonprofit organizations are included or excluded from this. It didn't speak to it either way. There are a lot of organizations in the nonprofit sector who are over the 500 employee limit and therefore weren't able to participate in PPP, and they're looking to this as the thing they will be able to participate in, but we're just not clear, we're not sure if that's going to happen. So we're waiting for the guidance to come out, which we expect soon, and we'll know more, and we'll share it with you as soon as we can.
And then we also had another question from Julie that said, can I use the MainStreet loan to pay for inventory that I can't pay for because of little revenue coming in? I think it's a great point that you raised, Julie, that while we have specific parameters of how we can use the PPP loan, at least at this point, and I'll let Mark or Jeff correct me if I'm incorrect, but it doesn't seem like there's restrictions on how you can use the loan other than, meaning you could use it for inventory, but obviously they talk about buybacks, they talk about paying down other debt would be impermissible terms, but I don't think you're as limited as to how you could use it for operations of your business. The interesting thing about that is it also seems right now, although we're waiting for additional guidance, that this type of loan could also be used for acquisitions, which is an interesting concept.
Yeah, no, I agree with you. At this point, the limitations are what I outlined related to not being able to pay off, repay, refinance existing debt, or certain compensation, stock repurchase, and capital distribution restrictions. But otherwise, yes, inventory to me would certainly seem to be allowable.
Okay. A lot of questions coming through about, can I just pay back my PPP loan? I would like to stress to people, you can without any prepayment penalty. However, you have a loan for 1%, and some of you might be, which is great, very comfortable with your cash liquidity position, I think you should seriously debate whether it makes sense to hold on to that and utilize that for other purposes. That being said, it's unclear how long you can hold on to it for other purposes because they do say that you have to utilize it by June 30th. So again, we need guidance on that. Okay. I took it out because I actually didn't think we were going to have time, but at a high level, I wanted to talk to you about the payroll tax credits. Some people, I want to throw a question to Jeff before we do that because I do think it's important. Jeff, one of the questions that came up said, we have a variety of grants that cover portions of our payroll costs. Would it still be appropriate to charge the payroll costs to the PPP loan proceeds debt forgiveness? Or are we awaiting additional guidance on that?
Yes, one of the open questions that we don't have an answer to yet because we're waiting for more guidance. I'm sure you're sick of hearing that phrase, but we're waiting for more guidance in terms of if you have some part of your operations that's federally funded or even funded by a state contract, especially in the nonprofit sector, but even if you're doing something for the Department of Defense or something like that, where it's covering personnel costs related to some of your operations, can you include those salary and payroll costs in your PPP forgiveness calculation? The PPP process will not pose that question. So the lender from whom you got your PPP loan will certainly allow you to include all your payroll costs in the forgiveness calculation. The real question is the other funder going to disallow you from claiming those costs against that funding stream? And we do not have a clear answer on that. So that is something that's kind of open. Some funders have weighed in on this with unofficial guidance, nothing official. Other funders have not spoken to it at all. And there's, as you know, a very wide variety of funders at the government, at various levels of government, to whom this might apply. So we do not have a good answer on that. The other question is this federal funds in terms of a single audit? If you're in the nonprofit sector and you have federal funds, or if you're a for-profit company that has federal contracts, there's certain rules and regulations about federal funds and audit requirements at the end of the year and reporting. Are these PPP loan forgiveness amounts going to be considered federal funds for the single audit? The AICPA has actually written to the Office of Management and Budget at the federal level and recommended that they do count as federal funds for single audit purposes for all those reporting reasons, because it would put some governance and audit infrastructure around these funds in terms of how they're being used. But there's been no response yet, so we do not know the answer to that question either. And those are two of the more common questions related to how this interacts with other government funding streams. Unfortunately, we don't know the answer to either, but we're certainly keeping our eyes out.
Great. I did get some payroll questions that I just want to address real quickly, hopefully. One says, if I'm a large employer, do I have any payroll tax credits? You definitely, I previously referred to it, have the ability to defer your OAFDI until December 31st, 2021 and December 31st, 2022. And if you're a large employer, that's not a small number. Reach out to your payroll company and talk to them. The only other payroll credit that a large employer who couldn't get a PPP loan could potentially get is the employer retention credit. And the employer retention credit essentially says you have to meet one of two tests. One test has to do with, did you see a greater than 50% gross receipts drop in your quarter analysis this year compared to last year? Just because you didn't see it in January, February, March, when comparing to January, February, March of 19, doesn't mean you might not, hopefully you won't, but doesn't mean you might not see it in the April, May, June timeframe. So just because you didn't hit it in quarter one doesn't mean that you would be not be able to reassess and evaluate whether you hit it in quarter two. The other, or quarter three or four. The other significant piece of this that I would also point out for the employer retention credit is if you had to, because of state or federal mandate, which I saw that's popping up through the screen, I can't have my employees on site, then you essentially could use the employer retention credit, again, for paying for those employees. However, if you're not having them on site, you might not have them there. You are correct, it is very clear that if you're under the 500 employee count, the Families First Corona Response Act does not apply to you. I tell you to be careful how you count that 500 employee count. It's different than how we count it for purposes of SBA, PPP loans. But essentially, the Families First Corona Response Act of requiring sick leave and requiring family medical leave, essentially if you're home watching a child who can't go to school, is for employers with 500 or less. We have heard this be an issue for Nancy Pelosi. She has been trying to expand that provision for larger employers and wanting that they having to pay for that as well. But I haven't, to be honest with you, the bill going through, I haven't heard any traction on it for at least 10 days. So that is something to be aware of.
Then can we go through some questions? I believe we're scheduled through 2:35 here, so we have a few minutes. I'm just going to kind of jump around here to try and get to as much as we can in the last 8 minutes. What encompasses utilities, gas, electric, phone, internet, trash collection? You know, I know, Lynn, they also talk about fuel.
So in the specific act, guys, the covered utility payments means the payments for electricity, gas, water, transportation, telephone, or internet access for a service that began before February 15th, 2020. For self-employed individuals on that guidance, they opened it up and it seemed like they were talking about gas, which wasn't in that initial definition. So I think it's, I would say those ones I just said out loud are definitely included. It's under the CARES Act. If you're looking at more than that or need more than that to look at for purposes of debt forgiveness, then obviously we'd be happy to confirm either way.
Would you say that those costs qualify for any facility that you're leasing, whether it's your main operating facility, your headquarters, your warehouse, or anything like that?
As long as you're paying it, right? As long as you yourself are paying it and you're not paying it to your leasor. And as long as that are the people who were incorporated in the PPP loan application.
Well, to that point, we did have several questions about camp charges. So if you're in a triple net arrangement and you're paying those, would those qualify in lieu of the utilities as rent?
Camp charges, I'm looking at, they specifically say a covered rent obligation means rent obligated under a leasing agreement in force before February 15th, 2020. So if the charges are part of the leasing agreement,
generally they are required, and then they're predetermined each year and adjusted.
Right. So I would say, to me, the way that reads, I would say yes, but I would want, I'm not definitive at this point until we get further guidance.
That's a great example of understanding the details in your expenses, so that if guidance comes out later that specifies, you can bring it out fairly easily and fairly quickly. So a lot of those details are not specified. You just have to understand your details well enough to be able to adjudicate it when the time comes.
And you remind me of a great point, Jeff, that some people unfortunately were offsetting the payroll tax credits they were receiving under the Family First Corona Response Act directly to payroll. And don't do that. Please make a separate account. They do make it very clear that your credits related to the Family First Corona Response Act will be included as income, but you can still then take the deduction for payroll below. And it's important to track those separately because payroll does affect a lot of different things we do in the tax and in other worlds. So it is important that you're not, so if you're paying $100,000 out, you're still paying it out. Now you're receiving a credit. The $100,000 deduction would go out, and the $100,000 credit would come in as income. Okay.
Can a company take the employee retention credit for weeks prior to receiving PPP if we kept employees on payroll?
It's a great question. It seems very clear to me that if you apply for the PPP program, and so his question, or his or her question is, the PPP employee retention credit is for people starting on 4/1. So he's saying if I'm still outstanding and I don't have a PPP loan, can I look at the employee retention credit? I would want to look into that.
What if one of my employees applies for the Family First Coronavirus Relief Act during my 8-week active PPP loan period? Will this impact my FTE count?
It won't. That's a great question about the FTE count, but it will definitely impact your debt forgiveness. So when looking at your payroll costs for purposes of debt forgiveness, if you're paying out and receiving an FFCRA, a Family First Corona Response Act credit, you cannot include that in your payroll for purposes of debt forgiveness. In the most simplistic example, I think that's okay though, because essentially, if you're paying someone out for paid sick leave, say you're paying them $5,000 for the week, yes, you have to decrease your debt forgiveness, but you already got that was free money anyway because you got to reduce your payroll expenses because of that. What that does allow you to do though is potentially use that $5,000 and hold on to it at a 1% rate or pay it back at the end without a prepayment penalty. So some people said, well, maybe I won't look for the FFCR tax credit. I don't think that's the right answer. The other thing I would say about the Family First Corona Response Act, please make sure you're optimizing the tax credit. Not only can you look at the gross payroll, and there's a lot of rules, so we're not going to get into that, the greater of 3 different options, but you can also, employer health insurance costs allocated to that employee can be added on top of that for purposes of maximizing your tax credit. And unfortunately, I don't think that's something your payroll providers know, and I think that's time well spent for you to get to that answer.
Really good question from the beginning. Any guidance as to what necessary means in the required certification? Current economic uncertainty makes this loan necessary.
Yeah, I mean, I think that's the purpose of why we're working with our clients to help them with internal documentation. And so, is there a definitive of what makes it necessary? No. We've had a lot of ranging clients and where that is. I would say to you, that's why the documentation is important. That's why getting the documentation approved by your board, if you have one, is important. I would also point out that, again, the funds had to get out, and I think the hiccup on this is going to be the audit requirement on the opposite side to make sure these funds were appropriately given to the right people and utilized for the right purposes.
Do we need to spend all the PPP funds by June 30th? This is the one that we've talked about. It's unclear. If your 8-week period extends beyond June 30th, we would think you would be allowed to go beyond that date. But, based on that chart, I believe it was on page 8 or 9 of the slides, we did show the column for use of funds, February 15th through June 30th, and forgiveness funds, which was your 8-week measurement period. So at this point, we would think, yes, you need to spend the entire amount of your loan between February 15th and June 30th, no matter when you received the funding. So in theory, if you were up and running at normal capacity February 15th through, say, March 15th, that means you have at least 6 more weeks where you need to have normal costs to hit that number, assuming you had 0 costs during any furlough period. So I would think it will be mostly attainable, but it's certainly could be a cause for concern.
Well, and then, but the other piece of this is,
Is there an impact?
And when you haven't spent it all by June 30th, it converts to a 2-year loan at 1%. Does that take it out of you being able to use it for now more things than just was originally provided in the PPP guidance? So.
And on that 2-year loan at 1%, because we did have a few questions on this as well, the 2-year clock starts on the date of disbursement. Approval and disbursement of those loan proceeds. Interest will begin amortizing on day 1, even though you have a 6-month deferral. And then to the extent you have forgiveness, you will get a reduction in interest as well. That will be forgiven on a pro rata basis based on how much forgiveness you received.
Right. So we've gone over our time limit. Based on the questions we saw today, you all know that this is not clear. It's about as clear as mud. So essentially, please make sure you're reaching out to your advisors. We have a team in place that's been helping significantly across our communities, and very appreciative for all they do. On a personal note, again, we know you're out there. We know your family and friends might be those people on the front line, the necessity workers. We are so appreciative for everything that you're doing, and we can't thank you enough for all that they're doing on the front line to make sure we can do things like this. And we are hopeful. As Como has stated, we think we're on the downward trend. Doesn't mean we're, it's not, doesn't mean we're back to normal. But, we like to hear that good news. As one of my favorite singers say, always stay humble and kind. I think it's a great, mindset to be in when we're going through this all together. I'm going to leave it to Mark and Jeff to say anything in addition.
I think you summarized it well, and we do appreciate everyone attending today. And keep the questions coming. We have our contact information here, and we'd love to help everyone that we can through this in your difficult time.
I echo all those sentiments. Thank you all.
Thank you, everyone.